Back to our top line discussion. Crude's putting more pressure on the loonie. North American stocks and the dollar are sinking amid this oil rout. Our next guest says this is a sharp correction in what he sees as a long-term bull market. For more, we're now joined by David Burrows, President and Chief Investment Officer at Barometer Capital Markets. David, good to be with you.
Great to be here.
Before we get to your long-term call, I think people are trying to really figure out what is going on.
Right.
What's your assessment of what's happening today?
Okay, so Catherine, we've been going through a structural shift in markets that goes back to 2011-12. Okay, so if you look at the U.S. stock market from 2000 to 12 years, the multiple contracted on stocks. There's money left to go to China, emerging markets, commodity producers, the things that were fueling the Chinese growth. In 2011-12, China started to slow, and all of the things that were built to supply that engine started to see softness. Now, we broke out of that 12-year range in the U.S. stock market in 2012, and we've been rallying since then. So we believe we're in a new secular bull market for consumer-based developed markets that benefit from falling prices and things like energy, right? Mm-hmm. Plentiful, low-priced energy. In the 80s, the U.S. was driven by technology, right? And that takes a long time to restructure an economy. And through going through a restructuring, we've seen emerging markets underperform for 3 years, commodities underperform. And we are at that point where it's becoming a crunch for those neighborhoods. Mm-hmm. Money has rotated to the U.S. for 3 years, and the U.S. is the biggest beneficiary because they have 70% of their economy driven by consumers who benefit from this. But
some people would say they haven't really benefited, that these retail sales aren't that strong. They weren't that strong this morning.
Well, and it's relative to what? Relative to what it could have been in the world we were living in 2008-9, right? So the point I want to make is that ultimately, when you go into a correction in anything, the weaklings sell off at the beginning, and as it picks up steam, the selling washes over into better and better assets. So emerging markets have been underperforming for a long time. Commodities have been underperforming for a long time. There's always the question, is it too much supply? Is it too little demand? But in the end, the U.S. market's been the most resilient. Now, in the last few months, the U.S. market has now started to weaken. Mm-hmm. If you look at the world markets, Dubai's down like 40% from the highs. China, Shanghai's down 38%. If you go through the list of markets, U.S. is at the bottom of the pile as far as how much impact. It's had about a 10% impact from the high, right? So it's been the strongest asset, and now it's under pressure because, frankly, there's uncertainty. People don't know how bad it is in China and how bad it is in commodities. Canada has been worse because it's closer to the epicenter of the problem, which is China. So I think,
So you're attributing all this weakness that we're seeing in the markets, that we're seeing in oil, to China?
Absolutely. Well, it's China on the demand side. On the supply side, people took a long time to realize that energy fundamentally changed. From drilling a hole and having a 50% chance of success 6 or 7 years ago to mass manufacturing today. You drill a hole, it's 100% certainty. So how much capital is there available for 100% chance of certainty? Lots. So the oil problem won't be over until there's no capital available for the industry. And that's a long way away. There's still lots of capital. Big companies getting share deals done easily, getting bond deals still get done. So there has to be restructuring. And China's going to have to restructure credit because there's likely to be a credit problem there. The U.S. is the best place to be, and in the U.S. the consumer is not hurt. But in the meantime, the uncertainty is at the point right now where it's impacting everything.
But David, I think that people had that view in 2015 and started to really question that view that the U.S. was still strong. Towards the end of 2015, people then started talking about the word recession. And now there not only is more talk about that, but even if you look at the most recent economic data, people would say, you know what, I've got to really think about a U.S. recession. You are not in that camp.
We're not. I think that in order to get the kind of correction we're getting right now, there has to be uncertainty, right? And there's a lot of people whose experience over the last 15 years has been 3-4 years, and then you get a big correction. In a secular bull market, you tend to have short, sharp corrections. They hurt. They're over in a hurry, and the market drives on, driven by whatever structural shift has been taking place. If you go back to the last secular bear market, from 1966 to 82, the market went sideways, just like the U.S. market did between 2000 and 2012. 3 years into the breakout into new highs, there was a 11% correction that took place over about 8 months. There was lots of volatility. Market turned higher and went higher for the next 10 years. The same thing happened coming out of the bear market of the 1930s and 40s. After 3 years of nicely rallying markets, market pulled back 9% in a very choppy price pattern. It's not an unusual thing. And what is likely to happen is it's going to shake a whole bunch of people out. Now, I'm not saying you don't have to play defense. We've been hedged in our portfolios and we've got cash. Our job is to be tactical. But I think the caution is don't think this is 2008-9 because there isn't the leverage in the system. You're unlikely to have that kind of credit problem in developed markets, maybe developing markets, because that's where the problem is.
But it's interesting because you say, and I had somebody else on earlier who said, look, don't worry about it too much. And he's actually out there buying. He's a big money manager, manages about $6 billion, used to be a former client of mine. And he's saying, it's not 2008, just like you said. There's not a lot of leverage in the system. But this is a different market structure. And I'm not saying that the market structure today is going to take us down for long, but I do think that there are concerns in the sense that, and I go back to this, you don't have the investment banks with the incentives to do what they used to do, which is take the other side of a client's trade.
Yeah, but
they don't want to do that. So my only concern in terms of stepping in right now would be that you've got people on margin. You've got high yield guys that can't sell their papers. They're going to short the equity markets instead. They're going outside of their area because they got to make some money and shore up positions.
So don't get me wrong. We have about 20% of our portfolios exposed. 80% is on the sidelines.
Meaning what? What's sidelines?
Meaning we have hedged against the market and
hedged.
cash.
All right.
Okay. So we have 7 funds. They're down between 1% and up 1% on the year.
That's really good.
So we are defensive tactically. But I will say where the exposures are is consumer, which is as far from the epicenter as you could be, healthcare, technology, 90% of our equity exposure in the US. Now, at some point, this will run its course. And it may be another 5 or 7% easily. And it can happen in a bull market.
When will you know to get back in?
So we have a couple of
unhedged
tools that we use to do this. So we track breadth within the market, or the percentage of stocks that are performing well. And we are getting down to a level where there's a very small percentage of stocks that are still bucking the trend. So we're getting close. A number of the short-term indicators we use are getting close. However, you don't know at this point whether we're going to wind up with a credit problem in emerging markets or a credit problem in the energy industry. I think we're a ways away from that. So what we need to see first, every major market globally really has broken the August and September lows. The S&P 500 is just doing it today. So there is risk that there's a few more percent to the downside. I'm not saying go buy this market, but I'm saying be careful about getting too bearish, because when it does turn, actually investors are underinvested right now, and it is likely to set up a prolonged next leg higher. And we don't have to have high growth in the US. Low, slow growth in a slowly improving world can be really good. I don't think we're anywhere near time to buy emerging markets or commodities or energy, which everybody wants to pick the bottom in.
What about Canada? Do you want to buy
So
Canada?
Canada, sadly, has a lot of collateral risk due to the energy industry. We haven't begun to see bankruptcies and restructurings. If you go back to the 90s, before the commodity bear market was done, almost every commodity company was run by a CA who was put there by the board not to blow up their balance sheet by spending money. We're not there yet. So sadly, I think it's going to be tough for Alberta. It's going to be tougher for the Canadian banks relative to US banks. Canadian dollar likely is going to remain pretty weak. And oil will overshoot to the downside. So we're not there yet. But on the other side, what is going to benefit from all of this is certain parts of the US economy which will help the US economy to restructure.
David, great to be with you today.
Thanks very much for having me.
Thank you.